Are you confused about the different types of trading and are you not sure which style suits you best? Well, let's break it down in this video. So at the end of this video, you understand the main trading types and how to choose the right one for you. So there are basically 4 trading styles. So now I'm looking at the Apple stock. And yeah, I will demonstrate it using TradingView, this chart. Let me start with scalping. So scalping is the first trading style that I will discuss. So what is scalping? Well, basically it's making multiple trades per day to profit from small price movements. So what you do, you go to the chart, right? You go to the 1 minute chart or the 5 minute chart. These are the best time frames to scalp. And yeah, the benefit of scalping is that it's quick and you make frequent profits, and you also have less exposure to market risks. The downside is that it requires precision and speed, and yeah, also high transaction costs. So yeah, who is this for? Basically traders who enjoy fast-paced trading and also can handle quick decisions. So what you do, I'm on the 1 minute time frame. Let's say that we wait for the market to open, which is about here, and okay, we see price stabilize a little bit, then it moves slowly to the upside. What we do, we grab the tool, and over here we see price goes to the upside. We take a trade with basically, in Forex we call it pips. Here it's points in stocks trading. So we aim for a few points. So what you can do, for example, is that you trade the gap, which is here. We see a huge gap, and then we are looking for the price to basically close the gap. So yeah, you can open the trade and then you aim for a few points, or yeah, as mentioned, you just aim a little bit higher, and in this case you aim to close the gap. And this case it was a nice winner. And basically a trading style that is for traders that like to stay in the trade for a few minutes. In this case it's a little bit longer, so perhaps this might be more close to day trading, because we started at about 4 o'clock and we are out of the trade about 4:45, so it's about 45 minutes, something like that. So maybe it's a little bit too long in the trade, but what scalpers often do is that they just aim for a few points and then they're out of the trade. So in basically minutes, 1, 2, 3, 4, 5 minutes, and that's it. Then we go to day trading. So as mentioned, day trading is more the example that I showed you over here. You are in a trade for not longer than a day, but it could be for, let's say, a few hours, something like that. What you do is basically buying and selling stocks within the same trading day, and you aim to profit from short-term price movements. And the pro is that it's quick profits, no overnight risk. It's really important. The downside is that it requires constant monitoring and also a little bit high stress, and it's best for traders who can dedicate full-time hours to the market. So basically you have to watch the chart for a few hours. For example, as soon as you see an opportunity, then you enter the trade, and then you also get out of the trade when the day ends. And day traders, of course you can use the 1 minute time frame, but personally I recommend the 5 minute or the 15 minute, because there is less noise. The 1 minute time frame, you have a lot of noise, and that's not the case on the 15 minute or the 5 minute. And over here it's really nicely visible. You also see a nice push to the upside, and then after, let's say, a few hours after the market has opened, you can take a buy trade, and then you also close out the trade. So let's say here we see that the price shoots to the upside after the open. When does the market close? It's about here, something like that. So that's a nice profit, right? During the day you're just in the trade, and then you also close out the trade before the market closes. Then we have swing trading, and swing trading is basically holding stocks for a few days to weeks to capture medium-term risks. So what I recommend is to go to the hourly time frame. Over here, the hourly or the 4 hour. yeah, maybe even the daily is also possible, but yeah, over here we see the hourly time frame. And yeah, what we do, we just stay in a trade for a few days or even weeks. For example, over here we have a nice uptrend, goes to the upside, then we see that it goes down and it also broke a support. So let's get the rectangle over here. We see it breaks the support level. There's a nice retest, so break, retest, we grab our tool, short position, and we take a sell trade. Put our stop loss a little bit above the latest swing high, and then we aim for, let's say 1 to 3 or 1 to 2, whatever you desire. But let's say, okay, let's say something like this. So that means that we are in a trade on Monday. Here's Tuesday, Wednesday, and eventually we get out of the trade on Friday. So that's the entire, all right, so the next, yeah, it's a Monday, all right, so that's entire week, right? We are in the trade for an entire week, and that's basically it. And now you have a nice return. Yeah, the pro is of course less screen time than day trading and also potential for larger gains. But the downside is that, yeah, you have overnight market risks, and yeah, it also requires patience. For example, over here we see it nicely moves to the downside, but we also have moments that it ranges a little bit and then it goes slowly to the downside, or it yeah, retraces, and then finally it goes to the downside. So yeah, you really have to be patient, and it's best for traders who prefer structured trades and moderate time commitment. And last but not least, we have position trading or long-term investing. So what we do, we go to the daily or the weekly time frame, but in this case I click on the daily time frame, and you have to identify the overall trend, which is in this case to the upside. It's a nice uptrend, it's bullish. So what you do, you wait for, yeah, really nice opportunities in which the market goes to the downside. So over here we have, this is a nice support or order block level. Price goes to the downside. Over here it retraces to this level, and then we see that price goes to the upside. So what you do, you buy basically dips of the market. So when news happens, or it could be anything, then yeah, you basically wait for the price that, yeah, retraces a little bit, and then when you see a nice bullish candle, you just take the buy order, and you, let's say you aim for the latest high, which is here, and also the resistance level, and then you are out of the trade on this date. So that's, you start on August 6th and you're out of the trade on 15th of October. So we have September and then we have October. So it's basically a little bit over 2 months that you're in the trade. That's basically position trading and yeah, long-term investing. You can also wait even longer. So that's about here finally. Then you're out of the trade, but then we are, let's say, about 5-6 months further, right? So yeah, that's basically long-term investing, and it's buying and holding stocks for years or months. The pro is that it is a least time-intensive approach. It's also a historically proven method for wealth building, and the downside is that it requires long-term commitment. Market downturns can also be challenging, and it's best for, yeah, investors focus on financial stability and wealth creation. So position trading and investing, long-term investing, yeah, that also, yeah, requires less and less screen time. So let me know down below, which type of trader are you? I'm really curious. If you like this video, give it a thumbs up and subscribe, and I'll see you in the next video.